Hello, I'm Ruth Krishnan with the Krishnan team, and today I wanted to talk to you about finance contingencies and what they mean, what does it mean not to have one, and what is your exposure. So a finance contingency is intended to give you protection while the loan is processed and underwritten to make sure that it's going to go through. Oftentimes in San Francisco, particularly in competitive situations, it's not unusual for people to waive all contingencies, including the finance contingency. So if you waive the finance contingency, you definitely want to make sure that you're underwritten. And if you're working with a great agent, that agent should work with the lender immediately to get you underwritten. Not all lenders are going to want to underwrite you. Lenders will do this typically as part of a relationship that they have with another realtor that's giving them 20, 30 deals a year, because it's actually a lot of work for them to do. So they don't do it for just one-off relationships with buyers in most cases. They will have to collect all of your documentation, send it over to the underwriter, have the underwriter look for it, and make sure that there aren't any sort of red flags within that documentation. It usually takes a week, sometimes 2 weeks to get done. It depends on how busy loans are at that time. And if you see a house tomorrow that you want to write an offer on and this process has not been done and everybody else has that process done, then those buyers that you're competing with are going to have the ability to put together a stronger offer than you will. Now, are there risks to waiving finance contingencies? The answer is yes, particularly if you're not underwritten, because then you don't really know for sure that the lender feels that you're ready and that there's not any kind of things in there that they're concerned with that need to be cleaned up. Sometimes they can find some, credit issue that you weren't aware of that needs to be resolved or different things like that. If you waive a finance contingency and then you find yourself in contract and then the lender is unable to perform, then technically your 3% deposit is up for grabs. It's not a black and white situation on getting that deposit back from you, as you have to actually sign it over. But in the case that you don't, sign it over, you'll probably find yourself hiring an attorney to pay for that. And if you're at fault, then you'll probably end up paying all the attorney fees. In the event that you find yourself in a situation where something comes up, there are oftentimes other lenders that can get things done that some lenders can't do. So some really great lenders like Wells Fargo, for instance, they're really great if your financial situation is very clean. But if you have a more complicated financial situation, then working with a different lender might be able to get done a deal for you that a big bank like Wells Fargo would not be able to get done for you. However, that deal will probably come at a higher interest rate. So if you have any other questions about finance contingencies, the risks, waiving them, or how it works, feel free to reach out to me and I'm more than happy to help you. Thanks so much, and I hope we get to talk soon.